Okay, welcome everyone. So glad you guys could join us today to come and talk a little bit about budgeting and financial planning during this time. Uh, Ask all the questions you want in the chat as we get kicked off. So I want to introduce myself. My name is Vincent Derman. I'm with the Premier Home Advisors team at Keller Williams Realty, and I'll let my partners introduce themselves.
I am Brandy Williams, also one of the partners and realtors with Premier Home Advisors at Keller Williams.
Hey y'all, I'm Brittany Johnson. I am one of the partners of Premier Home Advisors as well.
All right, great. So we will get started with our special guest for today. Um, let's see here. All right. So special guest for today is Mrs. Deidra Willis. She is a financial advisor, and this gives you a little bit of her background. She has been in the business for about 8 years now, and she does a great job at guiding her clients through financial planning, right, budgeting, um, putting aside things for as investments, and kind of navigating, what you should and should not do navigating through as we're navigating through financial planning for your future. So, Deidra, I'll let you give a few words before we kick it off.
Absolutely. Hello, everyone. Thank you guys again, Premier Advisors, for having me to join on today. I'm excited to have this discussion. I know that we are in some unprecedented times, and it seems that there's a lot of questions, probably a lot of fears. And so we're here to have some discussion. It's open-ended. Everything is non-judgmental. So we'll just get into anything that you want to discuss. As Vincent mentioned, the planning that I do is going to be comprehensive based on my clients. So it could be base level of making sure there's a plan established from a budget to all the way having an estate plan to doing some investments. So whatever your questions are, we'll delve into those today.
All right, great. All right. So Brandon, can you just kick off with the first question?
Perfect. So first question, and I think there's a lot of uncertainty right now. So how much should people have saved, just in general?
Absolutely. So in general, what we recommend is if there is dual income, at least 3 months of liquidity should be set aside. If there is a single source of income, or if there is dual income that's not comparable, then we recommend at least 6 months. And so what I mean by comparable, for example, if you have two incomes in the household, but one income is at 100,000 and the other income is at 40,000, that's not comparable. So if one lost a job or whatever the impact might be, we need more than essentially 3 months. So if there's dual income, it's roughly about the same, 3 months at a minimum, but if not, 6 months is closer to the goal.
Okay, perfect. I will go ahead with the next question. So for folks that do kind of have that income set aside and they're pretty comfortable right now, they're able to work from home, is now a good time to start investing?
I love how you frame that question. I love how you, because, I was thinking about, so here's the thing that I've been seeing a lot is a lot of people are either fearful to get into the market or very excited to get into the market. And the one thing is when it comes to investing, the first component is understanding yourself. And so right now, if you're wanting to start, and as you mentioned, what's really critical and what's key is having the liquidity, right? So we already at that goal. We're still at a place where our income is not compromised and we can continue to sustain. Now is, generally speaking, a good time to get into the market. Now, getting into the market really depends on the individual, because what comes into play is going to be really two things: the time frame. So how long do I plan to invest this money, or even what time will I need the funds? And then the other component is really going to be my appetite for risk. And so a lot of people are thinking, well, what is too low? What is too much? It really depends on the type of investing that you want to do. And just, just to give a little bit brief around that. So you could essentially buy ownership in a company, which is buying stock. And that's relative to how many shares you want to buy. You could essentially buy one share and you're investing. Or you may want to actually start to build your retirement plan. So you may look at something such as a mutual fund or anything of that sort, an IRA. And that's relative to whoever you're working with, the firm. There might be various minimums in regards to getting started there.
Okay. All All right.
But I love the way you asked that question.
Yes, yes. Don't want to just jump out there.
Yeah, you know, the one thing I'll also say too is when you think about investing, be comfortable with losing, right? So if you feel as though you're ready to invest, it should be money that you do not have a need for. That's the other way to look at it.
That makes sense.
In regards to getting started there.
So, Deidra, in terms of budgeting and saving and cutting expenses, you know, we've been hearing a lot about cutting expenses during COVID-19 if you have a reduction in hours or just with the uncertainty. Can you tell us a little bit about what the best tips are for budgeting? How much expense, you know, should we be looking at potentially cutting to increase that savings, or, you know, what types of things do you look at when you're looking at a strong budget to sustain in a market, in a economy like this?
Yes. So I feel right now is giving us an opportunity to get a lot of things right. We have time, we can take inventory. And so the one thing when it comes to budgeting, which we don't believe or we really don't recognize, is that a lot of it is just going to be based on behaviors. It's going to be based on our habits. So the first place we have to start is with us and figuring out, who am I when I think about my relationship with money? So that's number one. That's the first thing. The second thing is we got to shift our mindset. So you guys are business owners, and you know that when you start to take a look at finances, you operate a little bit differently from a business standpoint. So we have to also treat our budget and our household like a business. So that's a matter of knowing what's coming in as well as what's going out. So the tips would be, start where you are, because you want to make sure that the budget is truly realistic. Then you start to carve off the unnecessary pieces that we may not necessarily need. And so what I mean by that is assess all of your expenses. So you're going to have expenses that we know that are necessary and some that are currently not necessary. And I've been having discussions. People are saving thousands of dollars just because of daycare. Number one, people are saving, you know, hundreds of dollars because of spending or food. And so you can see, really, I can back into, there's two numbers when you think about the budget. One is my lifestyle. So my lifestyle is going to encompass all the things that I enjoy. Obviously my daily livings, but my discretionary spending, my fun, etc. And then the other component is really my essentials. So this is what I need to maintain at all times. So it's really identifying what are my essentials, what is my lifestyle, and what's healthy between the two. And then from there, one thing I also want to recommend is make sure you're included in the budget. So that's even the things that you enjoy, but more importantly, you should be your number one creditor. So if we're not paying ourselves, then we have it reverse. We got to make sure we take ourselves off, on the list and take it off top, and then have everything else to flow from there, because we have to pay those things. So those are some tips that I would share from a budget standpoint.
Thank you. Very helpful.
Good. Yeah. So we have a question and comment. Again, anybody that has questions, please place them in the comments and we'll read those for you. So Deidra, what's a great resource to track your spending daily? You know, several people probably tried spreadsheets before, they tried saving receipts, but what's a great resource that they can use to possibly track their daily spending?
So you have quite a few out there now with technology and innovation. One of the best places to get started is start with your bank. Believe it or not, if you already have your account tied to a bank, they have where now you can set up what is called budgets, and you can see where you're tracking at any moment of time. So that's one place because it's real time. Another really great place is mint.com. So a lot of people like Mint as well. There's a new app that's called Every Dollar. So essentially you put in, you know, your spend and what your goals are, and it's going to track every dollar. So some of those really take out of the thought behind it, which can be the hindrance when it comes to budgeting. Thinking, oh, I got to go and track and I got to figure out. It's doing the work for you. So your budget to actual. So I would tell you to start with those three resources.
That's great. That's great. There you go.
So, just for folks that, you know, are thinking about the future, I'm sure this made a lot of us think about the future in different ways. So how could someone prepare for their family? Like, how do we look at saving for the family or down the road? What's the best avenue for that? Or how do we really protect our family?
Absolutely. So I'm gonna break that out. So saving and then also protecting your family. What I want everyone to realize is that good, bad, or indifferent, there will always be something that comes up. So when it comes to saving, think about a contingency plan. And it may not always be the worst. It could be a really great opportunity we still need to have money set aside for. So when you think about your family, the best place to get started is to think about really your goals. So start to identify what would I want for my family, whether it's a family goal, whether it's a personal goal or a financial goal. So that's the first place to get started. And then also, what position will you want to be in if something were to happen? So right now, we're already in the midst of a storm, if you will, if you want to call it that. So it's hard to prepare when you're already in the middle of something. So how can we get ahead of maybe what's coming next? And again, it's going to be thinking about what position do I want to be in, even as a result of today. So we're feeling a certain way. We're seeing some impacts and some changes, a lot of things that we truly can't control. But what happens if you plan ahead, you don't have to plan by default. So that's what we're wanting to avoid, is to figure out how can I protect my family by knowing really what's important for me and my family and what are my goals for my family. And then another area of protection, I know we had the question around the life insurance component and why is that necessary? Why do I need it? I want to talk just about risks as a whole. So what we're doing when you think about money is really we're trying to get around risks, a balance sheet, right? At the end of the day, assets, liabilities, truly my number is what I own minus what I owe. What I owe is always going to be risk. So it's about a matter of protection there. And the biggest components to manage and protect your family, which is actually the foundation of every financial plan, liquidity, number one. So we got to make sure that we start to set aside savings, even if you start with the smallest amount. Believe it or not, what's going to be the game changer is the consistency. So once you get into a flow, you'll be able to elevate what you're currently doing. The other thing that's very important is going to be where a situation could occur and cause devastation. So that's an illness, right? So we got to have the proper insurance, it's health insurance. We need to look into having some type of protection against our income. So if I couldn't work, do I have disability at work or supplemental disability? Those things help to protect your family. Believe it or not, income is the number one reason why we don't reach goals. And it's also the number one reason for bankruptcies. So it's health related issues, most cases. And then what if I'm not here? So making sure that we have proper plans in place for life insurance. I always recommend that you have something you personally own, not just through your employer, because that's a contingency with being with them. So you want to make sure you have your own insurance as well. So those are the baseline to have the protection. If you're a business, you may have to take it a step further, because we know that technically business and personal is intertwined, and you have a little bit more exposure to risk. You know, a lot more people who may actually pursue legal structures and settlements, et cetera. So think about it from that standpoint. Am I protected? Is the business protected? Will this not impact my family?
There you go.
So the follow-up question, this one's a little bit to the left, I guess you would say. What is more important right now? Is it more important to save and get that 3 to 6 months in your savings account, or to pay down debt if you have additional money?
That was
I was about to ask the same question.
Okay, so here's the thing. When it comes to saving and paying down debts, it's not an or, it's an and. We have to do both. If it was a question between if it was a question between paying down debt versus investing, debt definitely first. But here's what we have to do is we have to figure out, and this is a matter of two things. Either we have to reassess our budget, or we have to determine, do we truly have enough income? Because what we want to do is make sure, first and foremost, we do account for what's necessary from a debt perspective. So I have to pay my bills. But if I don't have the liquidity, I can be over aggressive when it comes to debt, because now I'm exposing myself. And what happens when we have a need, right? We may go back to relying on that particular debt, whether it's a credit card or some type of loan. So we have to position ourselves to do a little bit of both, according to what our budget shows that we have the capacity to do.
Awesome. Good. Okay.
Going on that, kind of going down that trail of debt, because it seems that was a common one, or it kind of sparked some some light bulbs. What is the best strategy to reduce debt?
So this is a loaded question, Brandy. The reason why I say that is because it depends on the type of debt that you have. And again, the position that you're in. So let's talk about debts for a second, because I want everyone first and foremost to know all debts are not created equal. And there are some debts that you want to tackle before others. Think about some of the debts that we can have that could actually be a benefit to us. Those are the ones that we could probably address last. So what I mean by that, if we own property, perhaps there might be a tax benefit tied there. If we have student loans, there might be a tax benefit tied there. When it comes to property and when it comes to student loans, also those are going to have, or you typically lend themselves to have lower interest rates versus if I had a personal loan and then if I also had credit card debt. Vehicle loan obviously is explainable debt, so that's going to also have a lower interest rate as well. Typically anything with collateral, which is an asset that can be returned, is going to offer you a better debt position. So we can focus on those, if you will, to getting them off our plate sooner, more on the back end. Then we want to do consumer debt. The other thing to look at and consider there as well is, do I have the appetite to actually make purchases? Because if I'm planning to make a large purchase, when you start to take a look at credit scores and what's going to impact my ability to qualify probably for the best rates, it's going to be my consumer debts. So any credit cards, personal loans, we want to tackle those first. They generally have the higher interest rate if we're not on a 0% interest payment schedule. And there's no benefits really in having them. So that would be the way to start to approach and tackle debt. And then the other thing too is two ways of looking at which approach. So should I go with the largest balance or should I go with the higher interest rate? And what you have to do sometimes is, it's not going to always be a general statement and say one is better than the other. You may have to do some comparison, because if your balances are comparable, then you want to go with the one that have the higher interest rate, because then you'll save a little bit on the interest rate. If the balances are not, and perhaps I can go ahead and get some things off my plate, having those small success keeps the momentum going. So you may can tackle that a little bit sooner as well.
Good. Hey, so when it comes to that as well, I would say, people as they pay credit cards down and pay different credit accounts down, it's always good to keep those open, right? Because they
absolutely
reflect on your credit score.
Yes. So you still want to keep it open. Don't close anything at least 6 months, maybe even to a year, because it's still going to impact your credit utilization. So there's a couple of things to know, right? When it comes to understanding your credit, the scores are made up of quite a few things, but the two greatest impact to your score is going to be credit utilization and paying your credit or paying your debt timely. So credit utilization, all that means is that if I have a credit line of 10,000 and I have 5,000 and I've utilized, I'm at 50% utilization. So once we get above 30% of credit utilization, our score starts to reduce. So for example, if I had 10,000, but one card allowed me to have 2,500 and I chose to close it, now I no longer have a higher credit utilization that I can utilize for my benefit. So it definitely makes sense to keep it open. Another thing I want to caution everyone, and this is still in the works, it hasn't happened as of yet, but there are some discussions around how credit scores are calculated will be changing. And they're starting to look more so at personal loans, because what they're finding is a lot of people have consolidated credit cards to personal loans. And so they're wanting that to weigh a little bit more heavy on your credit score. So just keep that in mind as well.
Gotcha. So we have a few questions from the chat. One talks about credit. So are credit repair programs useful, or are most of them considered a scam? Do you have any experience with that?
I don't have much experience with it. I would not say that it's a scam. I think it depends on the individual. Think about yourself. Are you a do-it-yourselfer? Are you someone who wants to delegate? But you do want to make sure they're creditable, because what I find with most of those is you're paying someone for their time to do the things that you could essentially do yourself. And so a lot of what they're going to do is the research, the disputing, the follow-ups. And so if you're willing to do that, you can definitely do that yourself. But don't think that things are going to happen overnight. A lot of people think, oh, I can pay X amount and it's going to just remove from my credit. You can actually do some of those things yourself and see a difference within 3 to 6 months if you're willing to take the time.
Great. So I see another question on Social Security disability. So there's a person here that's on Social Security disability, and they say it's very hard to save because of all the doctor appointments and medicine. What can she do to navigate that?
Absolutely. So again, this is all going to be relative, right? Which is why I mentioned there's two components when it comes to your budget and saving. So one is, have I managed everything well? So we do have to step back and make sure that we're properly managed. And we got to take a look at our expenses and what can we do to make sure, number one, we manage. Number two, is still reasonable. Are there some ways and opportunities to cut back? And then the other is a matter of truly having enough income. So we feel as though where we are, and maybe we're operating on a set income, then take a look to see, are there any additional ways where maybe I can get a small stream of income? Is that possible? I know you can be limited when it comes to Social Security, specifically disability, of how much more you can make. So you may not be in that position, but start where you are. Again, even if it's $5 a month, I kid you not, do something so you can get into the habit of setting aside savings, right? And then maintain and continue to look at the budget piece, because I know it's going to be different based on where everyone is.
Going down, we talked a little bit about credit score and, doing certain things to boost your credit score. Is there a certain goal or number that people should be aiming for when it comes to credit score?
Well, not in a nutshell. I would say depending on where you are, because again, for some people, having a 700 credit score is amazing. For some people, they may want to get to 800 credit score. So where you want to first begin is looking at where you are. And if you're not in the 700s, make that a target to get to the 700s, right? The next thing I would say is if you are in the 700s, maybe you're 720, 730, that's still relatively a good score to probably get the rate that you want. But just try to constantly inch it up, because it's going to give you leverage. And so there's never going to be a number that's going to be ideal over another in terms of you've arrived, unless you're at 850, essentially. So just constantly look at different ways to where you can put yourself in a better position, because again, it's going to be leverage.
Okay. And what's the best place to find your credit score? And then what's the best resource of tracking your credit score?
So credit score right now, if you have a credit card, most banks now offer your credit score. So if you have the app, all you have to do is go to your account where the credit card is located, scroll down to the bottom, you'll see your FICO score. So that's one of the best places, believe it or not. You no longer really have to pay for your score anymore. If you have a credit card, to some degree, it's probably offered. If you don't have one, check with your bank to see if they still offer it, maybe on debit cards or checking accounts. And then always go back to reviewing your actual credit report on a consistent basis. So you can always go to free annual report credit score.com. And so you can take a look at that on a consistent basis.
Deidra, what are your thoughts around apps like the Experian app, where they give you information about your credit score, about your debt, and all that good stuff, and then they give you suggestions? They tell you to maybe open up a credit card to lower your, to do all that other stuff. Tell us a little bit about what your thoughts are, just kind of on, like, should people use apps like the Experian app? Should they pay? I think there's like a $19.99 per month fee if you want to use the app to its highest extent. What are your thoughts on that?
Yeah, so I probably have mixed thoughts. Should you pay? Not necessarily, because there's so many different resources that are out here now. However, I don't want to hinder anyone who may have been in a position and they're trying to come out, and that's going to keep them accountable. Or maybe they've had identity theft and they want to make sure they can keep track on some things. So in situations of that, I think it will be really good and beneficial to get going from that regard. Long term, however, as I was mentioning, if you have a connection with a credit card, they actually also give you how you can improve from a score standpoint. And so you could see the proportion of how maybe the debts that you have or the credit that you have outstanding. So you will also gain tips there. And then the other thing to keep in mind is that Experian, Equifax, and TransUnion, they are the 3 credit bureaus. If you're going to have any tie to having an app that's tracking your credit score, you want to go with those 3.
Okay, great.
Mhm.
Hey,
So
wait.
go ahead, Vincent.
I was just going to say, I've heard that the credit bureaus, or at this time, you can get a couple reports per year. They just
That's
open that
correct.
up. Is that correct?
That's correct. So as I mentioned before, freecreditreport.com. So that is provided by it's actually by the government. So every year you can get a free credit free credit report from all 3 credit bureaus. So you want to actually probably stagger it, if you will, meaning that if you want to keep track on it, a great way to do is maybe pull something on a quarterly basis, or try to spread it over 3 times a year, because you don't have to pull every bureau at one time. So you can just build that out over the course of the year so you can keep track of what's going on. And remember, you get a free one every year from all 3 of them.
Okay, great.
Awesome. And you guys don't forget to ask any questions that you have in the chat, or if you're on Facebook, in the comments, and we will be sure to get those answered.
Deidra, can you tell us a little bit about what an IRA is, what a CD is, what's the difference, when we should consider maybe utilizing one of the two?
Mm-hmm. Absolutely. So let's start with a CD. So a CD is a certificate of deposit. And so it's a time deposit, meaning that you only have the ability to get a CD with a bank or a credit union. And what it allows you to do is, in exchange for you giving a deposit for a committed amount of time, you'll have a premium on the interest rate. So for example, I might want to get a 12-month or 15-month or even a 60-month CD, and I generally will have a better interest rate than having my money in a savings account. Now, keep in mind that in order for you to receive that higher interest rate, you have to commit to the time. So that's the only thing to know about the CD. And then when it comes to an IRA, so an IRA essentially stands for an individual retirement arrangement. So it's an IRA is an individual retirement account. It's something that you establish yourself. Even as a business, there are various types of IRAs as well. And the one thing to know is that there's 2 types that's generalized from an individual standpoint, and it's very important to understand these. And so you have a traditional IRA, and you also have a Roth IRA. And just to understand those, one allow you the ability to defer your contribution today. So for example, if I made a contribution to a traditional IRA today, my income is going to be reduced by that amount. So I get a tax break today with a traditional IRA. If I were to have a Roth, the Roth allows me to go ahead and pay taxes now. So there's no taxation on the back end. So the difference between the two is, one is going to give you a tax break now, one is going to give you a tax break later. Both allow you to have your investments grow tax-free. So while it's growing, there's no taxation. But we think about taxes in a solution, and then trying to be well positioned down the road as well.
Awesome.
I want to go back to the CD real quickly, because are you familiar with money market accounts, Brittany?
Yes, but our friends might not be. So you can feel free to explain.
Absolutely. Money market accounts, high yield savings accounts are very comparable to having a CD. So oftentimes what I recommend is looking at one of those over a CD, unless the rates are phenomenally better, or you know for certain you don't have a need for those funds. Because with money market accounts or with high yield savings account, you can still access the money. So also that's another solution that could be possible as well.
Awesome. Good stuff.
Well, Deidra, tell me a little bit about some questions you're getting from your clients right now. How are they navigating what's going on right now? Are they kind of staying put? Are they making some changes?
Absolutely. So I'm getting a little bit of everything. As I mentioned to kick off the call, a lot of people have a lot of fears right now, with the market. More so my clients who are retirees or those who are getting ready to retire. One of the things that we're looking at is, does it make sense to rebalance the portfolio? And all that means is looking at how we're currently allocated from a risk standpoint. I'm also getting some of that from my younger clients. And what I'm telling them is absolutely, let's not change, stay the course, because the market will rebound. And if we don't have a need for this money anytime soon, it could be more of a detriment pulling money out of the market because we'll miss it when the market comes back up. So that's one thing. Plus, I have a lot of people who are very anxious and excited to actually start an investment during this time. And it goes back to the question that Brandy mentioned before, is being well positioned. And if you're well positioned, it is a really good time to get in the market, because essentially think about those who like to shop or those who know how to find deals, the market is down. Meaning you're getting at a discount. But I'm getting a lot of that. I'm getting a lot of people being concerned about just making sure they have the right liquidity, making sure they have the right insurances in place. So it's really more just trying to calm fears. And at the same token, I'm reminding my clients to stay focused on the outcome and in the outlook, right? So we don't want to stray away from what are the goals. Obviously, we have to maybe adjust and pivot during this time if we need proper liquidity, and we got to assess our expenses. But if you can maintain your focus on your future, you're going to come out better than you went in this time.
Awesome. We have a couple of questions on Facebook. So one question is, what are some debts that are easier to dispute when cleaning up your credit? Or is there a such thing? Like, is it easier to dispute a credit card versus a medical bill?
I don't know if it's easier. If it's not yours or if it's not accurate, it's very easy to dispute. I would say it from that perspective. If we're thinking between the type, maybe a medical bill might be a little bit easier than a credit card. Obviously, if it's your debt from a credit standpoint, you utilize it. We really can't dispute it unless the amount is incorrect. So if the amount is incorrect, it's much easier to dispute. When it comes to medical bill, sometimes we're not made aware of. You may have never received the bill. You may have not gotten notification of why you actually have the bill. So that might be a reason to be able to dispute a little bit easier than another type of debt.
Okay. Another question, I believe this is going back to the CD versus the money market. Do they both guarantee a rate of return?
They do. They do. So both of those are what's considered to be safe type of ways to have a little bit of interest. So they're not in the market, essentially. With the CD, you're going to have that guaranteed rate of return for that time period that you commit. For the money market, it could definitely adjust. So for example, we're in times where we have very low interest rate environment as a whole. And so you might start at a 1.5%. And if we constantly lower interest rates, then you might go down on that. So it can adjust during that time period, but also you give up or you have the ability to have access to the funds during that time.
Gotcha. Okay. And then going back to investing, do you have any resources or maybe apps or companies that you would suggest for someone who wants to start investing?
Yeah, so it depends on the level of investing that you want to get started with. If this is something where you're wanting to get your feet wet, you want to do it yourself, and you don't necessarily feel as though you need to work with someone as an advisor, then take a look at some of the apps. I don't have any app particularly that I recommend, but if you want to get started, you have apps that will allow you to link your accounts to them. And that way you can start to just have a little money set aside that's growing. Or if you want to be a little bit more sophisticated, you think you might want to learn more and do more research, you do have platforms such as like TD Ameritrade and different things of that sort. What I would recommend more than who would be go with someone that's discounted if you're planning to manage it yourself. So just take a look at what are the fee structure, the expenses related to that. But if you're wanting to do more consistent investing, you're going to probably start at a larger level. You definitely want to sit down with someone like myself and have the conversation around investing, because what we do is we quarterback, if you will. We build out an entire portfolio. So oftentimes we don't see a lot of things as an individual that we can give you some insight and wisdom on.
Awesome. Perfect. We do have another question in the chat here. What do you recommend for business owners looking to lower their tax burdens?
That's an excellent question. So I love working with my business owners because the planning is a little bit more complicated, which means it's a little bit more exciting from time to time because there's so many different things to figure out. But the first place to get started with lowering your tax burden is just make sure you're doing a really good job with tracking. You don't have to go and buy up everything to think that you're going to write it off. So don't do that. Just definitely start with managing and know what you can truly deduct, right? So that's the first thing. Is you're going to also have to have a business budget. You're going to have to track those expenses that are truly for the business. And you're going to have to work with a very strong tax professional who can teach you how to leverage certain assets from a business standpoint. Another way that you can deduct things from a business perspective is your contributions to retirement. So as a business owner, you have a little bit more leeway in terms of how much you can contribute, which is truly a deduction automatically from a business standpoint. So oftentimes we look at ways from that perspective. And then if you believe in rewarding your employees or having benefits for your employees, that's another great way to be attractive and another great way to retain them. And that's also a benefit for the business as a tax deduction.
Awesome. Perfect. So obviously our team is a real estate team. So talking a little bit about savings and preparation, what would you say is a good amount to have saved in order to buy a house?
Mm-hmm. So 2 buckets of money. The first we want to do is we want to always maintain the liquidity that we need just as a whole. So going back to what I mentioned before, depending on what category you fall into, whether you need the 3 months or the 6 months. So that's first thing. Second thing that you need to have set aside is the down payment, which is going to be separate of that 3 to 6 months. So if you at a minimum have those 2, I feel like you're in a position to feel good about buying a home. Other things that you want to assess just to make sure you feel comfortable, because once we get into a home, we never know what can happen, right? We need to truly have a house fund that we have set aside or even start to accumulate. Is make sure that you're in a really good position, even with your other debts, and that if anything were to come up, you can also sustain. Because when you get into a home, the expenses are much larger. An AC unit goes out, that could wipe out the entire 3 to 6 months of saving for some. And so that is what I would tell you, to make sure that you have the proper liquidity and you also have the down payment as well.
Hey, that's good info. Again, thank you for sharing. Oh, looks like we have another question in the chat. If I'm mistaken. So, do you recommend investing in what you like and understand when it comes to stocks or real estate or any other type of investment? What's your advice on that?
100%. The best place to get started when it comes to particularly individual stocks that you might choose to buy yourself are companies that you have an affinity for. Why? Because you're going to understand them a little bit more. Most likely, you're probably going to know what's happening in that particular industry. So again, going back to the investment piece, if you can take away anything, a lot of it is going to be not really what's happening in the market, because we know that the market is moving for a very reasons, if you will. But if you understand yourself, if you understand the product, or if you understand the company and the management of the company, that's really what you're looking for. So start to see, what do I spend my money on? What do I have around my home? What industries am I interested in? That is a really great place to get started. Do your research. And when I say do your research, don't just look at the numbers. Look at innovation. What's coming out? Are they launching new products? Look at the way that management is running the company. All of that is really going to determine the success of the company. Obviously, you might have something to come into play that is uncontrollable like today, but if the company is solid, it will sustain. So absolutely, Vincent, that's a really great question. Is start with what you know. And then from there, once you start to expand into doing more investing, just start to diversify your portfolio. So what I mean by that is, somebody is really interested in technology and maybe they start their first investment with a tech stock, then expound from there and do a stock in a completely different industry. It's going to give you an offset when one industry is down or up versus the other.
Good. Hey, there's a really good question from Facebook, and I actually was going to ask this as well. So this is a comment on Facebook. Are there any books that you would recommend that people pick up and read about financial planning or whichever subject?
So there's, oh my gosh, this is probably the hardest question I get, because I feel like there are so many different books and it really depends on the angle that somebody want to get in. I do a lot of reading, but a lot of my reading is really specific to, the industry, if you will. Some of the foundational books that I really, really like, that goes to like the discussion we were having earlier around the budget and understanding your money, is The Richest Man in Babylon. That's a really great foundational book. Obviously, a lot of you guys, and I'm gonna start with the fundamentals. Rich Dad, Poor Dad. I know you guys have heard that as well. That's more of a mindset book than anything else. The Intelligent Investor is a really good book. The Millionaire Next Door. Like, some of those are just the foundational and the fundamentals when it comes to understanding the baseline. I will also tell you to do a couple of things. Start to tune into like Money Magazine. It really lays out some of the simplistics of just understanding money. Another really great source on TV to tune into is going to be CNBC. So especially for those who starting to think about investing, even if you tune in at lunch for 10 minutes, you will understand probably what's going on in the market and why. That's going to help to relieve some of the fears. And then you understand, well, okay, well, this is probably why the market is moving, and I don't have to get anxious because there's a market swing. So I would tell you to do it from an array of different things, but I always get stumped on the books because there's so many that I read. It just really depends on what somebody have a need for.
And that is the fact that you started with The Rich Man in Babylon. I literally just finished that book a couple of days ago. And so do you agree that if someone is wanting to start small when it comes to saving, one of the things in that book is, every dollar that comes in, set aside 10%. Is that a good way to kind of start small? Or if you have no savings, should you aim for larger than that? Or kind of what does that look like?
So I was just going to ask your feedback. And what did you think about that book? I love that book just because it just meets you where you are. Regardless of where you are, you can really take hold of different things in the book. So 10% is ideal, but let me just say this. 10% saving is not going to get us to where we need to get to today. So that the notion of saving 10% and being okay is no longer the case. And the reason why that's true is because the systems that were set up before for our parents or grandparents, most likely most of us today won't have those. So we won't have the pensions. If we have Social Security, it's not going to be where we can rely on it as a main source of income. So the 10%, we need to actually be saving roughly about 20% of income. And that 20% is across the board. So whether that's, what we're doing to a retirement account, so pre-tax, or even what we're doing, we bring it home after tax, it encompasses that full number. But the right percentage really depends on where the individual can commit to. So if that's 2%, I kid you not, make that a success point and commit to doing it. Whatever your number is, and you know that you can commit to doing it, start there. And then every opportunity, if you eliminate a debt, if you knock out an expense, if you increase an income, increase your savings, make it systematic so that it's no question.
That's a great point. Hey, so I've heard from several folks growing up and older people about how much of your household income should be dedicated towards your household expenses. So is there a percentage, say for instance, I shouldn't be spending more than 50% of my income on my household expenses? That's including cable, rent, mortgage, whatever it may be. Do you have a good figure we should be looking at for that?
Mm-hmm. Yep. So there's two numbers I'm going to give you guys to understand. So the first thing is, a lot of people operate on like the 20-20-60 rule or the 20-80 rule. But if it goes back to what I just mentioned of having roughly about 20% set aside for savings, then how do we divvy up the rest? What I want you to understand is there is discretionary spending and then non-discretionary spending. But what I do is I break it down more so by categories than anything else. So for example, housing, transportation, debts, and then fun. So when you think about your household, what we want to do is probably maintain anywhere between 25, which is a really, really extreme, someone who's excellent probably with their expenses, to about a 35 to 40% from a household perspective. And those are the baseline we need from a living, your utilities, different things of that sort. When it comes to transportation, we want to be anywhere between or below, let me just say below 15% ideally from a transportation standpoint. Same thing for debts. We want to be below 15% ideally. And then the rest will go to some of the discretionary spending, which could include groceries, because that number is not really a hard number. Everyone is going to be a little bit different. But look at a percentage by category to make sure you're within the parameters, if you will.
That's good. Hey, Brandy, did you have something? Sorry.
No.
Oh, okay. Oh, wait, I'm sorry. I think I have Brittany on mute. Here we go, Brittany.
Okay, so good stuff. A lot of times we hear about life insurance, and some of us have that misconception that you don't need life insurance until you get older. Can you talk to us a little bit about the importance of having life insurance, the different types of life insurance that you can have, and at what time you really should be looking at putting your money towards something that's going to build your future?
Mm-hmm. Yeah, that's an excellent question, because this is probably part of every discussion that I have, because it's part of that foundational plan that we talked about before in managing risks. Well, let me just say this. even if you're single, even if you don't have children, even if you don't have somebody relying on you, if you're breathing, you need life insurance. And the reason why I say is because obviously we know that we're not going to be here forever. So that's the one thing to know. The other thing about life insurance is that life insurance is truly a tool that yields great impact, legacy, and generational wealth. So I always try to educate my clients when it comes to that regard and that perspective around the life insurance. And then the other things that you mentioned is the sooner you can get it, the better it is for you. When you look at life insurance is age sensitive and health sensitive. So obviously, as we're getting older, we're getting closer to mortality, which means that we're at a higher risk. So the rates are going to increase. But the biggest component that we don't realize is our health. We have to medically qualify for it. And so we could be in a position at some point we actually can't have it because health has changed. And so when we're younger is actually the best time to get life insurance because of that. You have various types. And where to get started in terms of what do I need, what do I have a desire for? If you think about the simplicities, right, that will help you to know exactly what you have. You're going to hear a lot of things from experts such as myself. Sometimes people don't know, we give them a barometer. It could be 10 times salary, it could be 20 times salary. But what I do specifically is have a discussion and I break down what would you want the insurance to do. Because once you know what you want it to do, how you want it to impact your family, then you know for certain that you have the right amount and you feel good about what you have. So think about debts. Do I want to eliminate any debts? Think about income. So if my income is no longer here, will my family be impacted? So maybe I should replace the income that will be lost by me passing away. Final expenses. Obviously, we want to make sure we plan for final expenses. And then think about education. So if I have children, I want to make sure those things are covered. That way, you will have the right amount of coverage. And then the other question that you mentioned was the various types. So essentially, there's only two types. One is term coverage, and then one is permanent insurance. And really, the name implies what it means. So you can get term for a number of years. So it's temporary in nature, or you can have permanent, which means it's going to be there forever. And the main difference is that one, they're both great solutions depending on what the need is. So that's why you analyze and assess the need. And so term will give you a lot of coverage, relatively inexpensive. The biggest caveat is not going to last forever. Permanent will give you a death benefit along with living benefits. So it's a really great place sometimes for individuals to save for safe money and different things of that sort. She's on mute.
Yeah.
Awesome. Thank you so much for that. So when people are looking at creating wealth for their future, so getting life insurance, I know that there's some policies where if you have an emergency or if you need funds to send your kids to college down the road or whatever, you're able to pull from it and not get penalized. I know we're getting a little detailed, but can you talk to us a little bit about that? Absolutely.
So again, it's really important for everyone to understand the two types, term and then permanent insurance. So term is, we're going to take it off the table because what you're referring to is the permanent insurance. But the reason why I want you to understand term is because term is temporary in nature. It's only a death benefit. The permanent insurance of which you're referring to, Brittany, is it's going to be there. You might hear whole life, you might hear universal life. All those are the various types of permanent insurance. And it offers more than just a death benefit. There's a living benefit. So what happens is, think about term as renting. And this is so great because you guys are realtors.
I know.
Term as renting, and think about permanent or whole life as owning. And so when you own your plan or when you own your home, you're building equity. And so essentially the same thing happens in a permanent solution. It allows you to build equity, which is considered accumulated value or cash value. And that's a benefit that you can utilize while you're living. Definitely there's a lot of great benefits tied to it, tax diversification, liquidity. And so a lot of people like that. And then the money is also safe in most regards.
Great.
So it's another great tool to have with your portfolio. And now is a really great time to see that for a lot of people who need access to cash or who don't want to pull money out of the market. We go to a safe resource such as permanent insurance as well.
Great, thank you.
Mm-hmm.
Deidra, it definitely sounds like you are a wealth of knowledge. And so just to kind of close things out, or, see if we get any other questions, what's the benefit of working with a financial planner?
Absolutely. So I like to say the greatest thing that I bring to my clients more than anything else is not having that excellent portfolio that we may have designed, or even getting the debt off their plate. The greatest thing that I believe a financial advisor brings is clarity. And what I mean by that is because it's so oftentimes when you're in and you're trying to do something for yourself, it's just like in a court of law, you really can't speak on your own behalf. So having someone that you work with who can pull out the best in you, who can understand really what matters to you from a non-financial perspective, helps to make everything else easy. So once you know and your goals are clear, decision making is easy. So you have someone who you trust, who trusts you, who believes in you, who's going to help you to design and develop a plan. So as a financial professional, as a certified financial planner, as a fiduciary, I'm looking at things a little bit differently than my clients. I can see around the road that maybe perhaps they can't see, a lot of things they haven't thought about. Plus, as I mentioned, I quarterback, and I make sure that you have a really solid team, because in addition to myself, we might need a banker, we might need a tax professional, we might need a legal advisor, if you will. And so we really have the ability to play so many different roles as a resource that help to bring everything together for an individual.
So how would someone get in contact with you to learn more about your services?
Absolutely. Well, let me first say I would love for you guys to, I believe in, this is probably my passion, because I'm pretty sure you can see. I know Vincent is going to share my information here. You can always go out to my website. There is a way for you to input your information. It'll send me a notification directly. I'll reach out so we can schedule. You can reach out to me directly if you wanted to do that via email or even via phone. I'm on LinkedIn as well. So I'm always accessible in any regard to connect with others.
And let me ask, because I see it's a Charlotte, North Carolina address, and obviously everyone on here may not be in Charlotte. Can someone outside of Charlotte or outside of North Carolina, can they still work with you? That's
an excellent question. Absolutely. So I am licensed in probably 26, 27 states. On the insurance side, the investment license is more of a national license. So absolutely, I have clients all over from New York to California. And so, and then the other regard too is if I'm not particularly licensed in that area, we still meet, have a discussion, figure out if this is going to be a really great working relationship, and I might connect them with a colleague in the area. So please, even if you're not in Charlotte, definitely I would love to connect as well.
And I want to give a quick testimony. Actually, I used Deidra as a financial advisor. So, and it was years ago before I moved to North Carolina. So she is definitely going to work for you from any state that you're in. So,
Thank you.
Awesome. Well, I'm checking across the board to make sure we got all the questions. You guys asked some great questions. So thank you for tuning in and for participating. I want to give everybody a couple of minutes to just make sure there aren't any questions that we're missing.
Yeah, and while we're doing that too, I just want to mention, of course, we are a real estate team. We do have those services available even during this time, and we have some packets here that we probably can't see them. Okay, that we like to give out if you need our services. And so contact us. You see our contact info there. I'm sure a lot of you are personally connected to one of us, so that would be great. Of course, if you want to get in touch with Deidra and you don't have that info, let us know and we can forward it to you.
Absolutely. And follow us on social media. You see our Facebook and our Instagram is at Premier Home Advisors KW. Follow us on Instagram, on Facebook, so that you can be in the loop about additional things that we do similar to this, where we're talking about finances, or we're talking about the process of buying a home, or just what to do during this time. So that is a great way to be sure that you know about everything that we're doing. And next time we do something, be sure you invite someone else to come with you.
Last thing as well, hey, if you want a copy of this video and this presentation, please insert your information on the link I provided, so you can get a copy of the video and this presentation, and we'll get that over to you. Look in the link in the chat or on Facebook.
Yes.
And as I mentioned a little bit earlier, real estate is still moving. Even though we're in dealing with COVID-19 and stay-at-home orders in different areas of the U.S., real estate is still moving. We still are helping a lot of people in our area. Vinny, I think you can give a testament to your area up north. Real estate is still moving, so we are always open to receiving referrals. So if you know someone that's looking to buy a home or sell a home or go and get into some investing or even potentially get their